Hi dear traders and investors, I'm glad to present to you a red hot market review prepared by analytics and forecasters fx.co portal. Here we go. Today is December 21. Let's discuss USD GPY pair. Bank of Japan surprises markets with its sudden hawkish decision. Jakub Nowak discusses. Yen shot up on Tuesday after the Bank of Japan made a very bold decision on monetary policy. However, what is more important is the statements of Governor Haruhiko Kuroda, which gave investors an indication of what to expect when the policy ends. Yesterday, Kuroda shocked markets by announcing that he will allow 10-year bond yields to rise to around 0.5%. This is obviously a strategic adjustment to buy time and determine the yield curve next year following the changes in central bank policy when interest rates are focused to rise. Currently, the yield on 10-year Japanese securities is at 0.46%. This has led to a rise in Japanese bank stocks as investors are waiting for higher returns from financial institutions. Kuroda said all decisions taken were in order to increase the effectiveness of monetary policy. Given that his term ends next year, there will be at least 2 more meetings under his leadership, which means that his successor will complete the path to policy normalization. But there are those who point out that high yields will mean unrealized losses on Japanese government bonds, including those held by the Bank of Japan. A sustained policy change could also hit Japanese stocks, as well as break the latest bond yield peg and trigger a sell-off in dollar in favor of yen. That will lead to Japanese investors diversifying from overseas instruments, which could result in a sell-off in emerging markets. The forex market reacted to these by moving quite strongly. In USD GPY, there is a strong support around 130.20, and its breakdown will lead to another sell-off around 126.20 to 121.10. Continue to detailize dollar-yen pair with Laurie Bailey. Yesterday, after the Bank of Japan announced that it has decided to expand its target band for long-term government bond yields and increase the volume of bond purchases on its balance sheet, the USD GPY pair collapsed by 3.79%. The lower shadow of the daily chart candlestick exactly worked off the support of the monthly chart's embedded price hyperchannel line at 130.58. Crossing this level of support will make 126.90 the next level target. But so far the price in corrective growth is headed to the upper line at 133.33. The Marlin oscillator settled in the negative area. It has a decent margin of the distance in moving down. We're waiting for the correction to end. An attempt to overcome 130.58. An attempt to break through 126.90. On the 4-hour chart, the price makes a standard correction after strong movement. The Marlin oscillator is in a hurry to get out of the oversold area. And the higher it rises, the longer it will decrease. The limit of the correction is the nearest resistance of 133.33. But the price may not reach this level. Trading from support and resistance levels with Jakub Nowak. Pound sterling, USD. Long positions, you can buy pound when the quotes reach 1.2187 and take profit at the price of 1.2270. Growth will occur if there are weak US reports, but remember that when buying, the MACD line should be above 0 or is starting to rise from it. Pound can also be bought at 1.2135. However, the MACD line should be in the oversold area, as only by that will the market reverse to 1.2187 and 1.2270. For short positions, you could sell pound when the quotes reach 1.2135 and take profit at the price of 1.2055. Pressure will return if there is no bullish activity at the weekly highs. But take note that when selling, the MACD line should be below 0 or is starting to move down from it. Pound can also be sold at 1.2187. However, the MACD line should be in overbought area, as only by that will the market reverse to 1.2135 and 1.2055. Gold, sweet gold. Golden tips with Marek Petkovic. Gold loves uncertainty but can stand high interest rates. In this regard, the rally for gold against the background of the Fed's intention to bring the cost of borrowing to 5.25% looks paradoxical. Moreover, 2023 is unlikely to bring as many shocks as the outgoing 2022. Investors want to believe in the best, in the end of the armed conflict in Ukraine and a soft landing of the global economy. But it doesn't always work out the way we want. Hope the best, but prepare for the worst. Uncertainty has allowed the precious metal to soar twice in the past 3 years above their psychologically important level of $2,000 an ounce. The panic in the financial markets due to the pandemic and the subsequent recession allowed gold to set at an all-time high in 2020. In 2022, due to the outbreak of hostilities in Eastern Europe, the analyzed asset once again fought like a king, but its joy was short-lived. The tightening of the Fed's monetary policy has become a verdict for the bulls on gold. The inability to generate income in the course of gold, it falls when the real rates on US Treasury bonds rise, which seemed logical against the background of the aggressive monetary restriction on the Fed. This increases the opportunity cost of holding the precious metal, which resulted in a continuous outflow of capital from specialized exchange-traded funds for at least 7 months in a row. But by year's end, gold has risen from the ashes, thanks to the intention of Jerome Powell and his colleagues to slow the rate of increase in the federal funds rate. Of course, investors can't be wrong. According to Goldman Sachs, the greatest effect of the tightening of the Fed's monetary policy is manifested 6 months after it started. This can explain the significant slowdown in US inflation in October-November. Nevertheless, the effectiveness of the monetary restriction is subsequently reduced. Consumer prices may rise again, forcing the central bank to raise the cost of borrowing above the 5.1% forecast by the FOMC. If this happens, the precious metal will fall into a wave of sales. The Bank of Japan's verdict to expand the target range for bond yields from 25 basis points to 50 basis points sowed new uncertainty in financial markets. And due to this uncertainty, as we know, gold is strengthening. Technically, on the precious metals daily chart, a rebound from the fair value of 1,785 per ounce provoked a new round rally. This indicates the seriousness of the intentions of the bulls. If they manage to storm the resistance at 1821, the upward trend will continue. We will get a new entry point for long positions. That's all for today. Have a nice trading day. See you next time.